Stephanie, it's great to have you on. First, your read on the ISM manufacturing data didn't really illustrate a strong picture.
No, it really didn't, Seema. It actually was a little bit worse than expected. We've now seen declines in 3 out of the last 4 months from the ISM manufacturing survey. It came in at 50.9, so it is still expansion, but barely so. And orders and employment were very disappointing, definitely showing a slowdown. That's what we're looking for, right? That's what the Fed is looking for. But the interesting piece was the price index fell to the lowest level since June of 2020. So that's good news on inflation. So prices are starting to come down. So as you mentioned, we do get other data points this week. I think we do get the ISM services figure, which I think is going to be in the mid-50s. That's a better reading. JOLTS, we get job openings, about 11.1 million, still quite strong. And then you mentioned the non-farm payroll numbers. Certainly all eyes are going to be on the average hourly earnings figure, which is expected to be up 5.1%. And that's what the Fed is looking for. And that's much too high in their estimation. So let's watch that number.
And then there's the unemployment report, right, Stephanie? If it goes above 4%, speculation about a Fed pivot, even though Mohamed El-Erian says the market likes to fixate on whether that is going to happen.
Yeah, no, I mean, I think it's much too early to talk about the Fed pivot. It's just much too early. There's too many stickier parts of inflation right now out there. Mentioned wages, but also rents are still quite high. And that's going, those two pieces, along with education and healthcare, those are going to keep inflation much more elevated. So even if we come down from the 8.3 CPI number and the 4.9 core PCE number that we got last week, it's still going to be high, and the Fed is still going to likely be hawkish.
Let's talk about a couple of stocks that you are going to be watching this week, not necessarily suggesting, but you have your eye on American Electric and McCormick. Why those two, and why are they somehow tells about the economy or the market?
Well, and it's good to see you too, Tyler. American Electric, I rarely come on the show and talk about utilities. I just don't really have a lot that I'm invested there. However, this is an interesting company. They're doing some very good shareholder-friendly actions. They have twin goals, ESG as well as growing earnings at the same time. And while you wait for this to develop, the stock actually offers a 3.6% yield, trades about 17 times, not super cheap, and that's one of the reasons why I don't own it yet, but it's certainly on my radar. But I think they're going to have an analyst day, and I think we're going to get updated total revenue and earnings estimates. They have a CAGR to grow about 6 to 7% in earnings by 2026, and they're heavily investing not only in transmission and distribution, you know, the typical utility stuff, but it's also renewables. And so to that extent, they are actually selling their unregulated renewables portfolio, and I think that'll be a nice catalyst for shares. So I expect shareholder-friendly actions as a result after they do that.
And McCormick, the spice company.
Yeah, you know, so I don't expect fireworks because they already pre-announced in early September, but this is a tell on the consumer and the trade down, right? So when they lowered guidance by 13% in the median, 1% was a hit from marketing spend. Okay, fine. 4% from supply chain, but 8% was volume weakness. So that tells me demand destruction. They have been putting in lots of price increases, double digits, and that's starting to impact the consumer. So we're going to get more of a tell on the consumer versus any kind of stock action, in my opinion.
And we've got a week to wait, but next week, Big Friday, banks, Morgan Stanley, Citi, JP Morgan, Wells Fargo.
Yeah.
What do you think, in a phrase or two?
I'm calling it Super Friday. I mean, I think we know that all of these companies are going to benefit from higher net interest income, net interest margin. That's because of interest rates. But then you're going to see very mixed results in investment banking and sales and trading and mortgages. So I think the companies that'll benefit from higher rates plus good expense management, I think they are going to act better. Out of the 4 names, Morgan Stanley, Citi, JP Morgan, and Wells, I prefer Wells into the print.